Alrighty, what is going on, everybody? Welcome back to another CYPRX video breakdown. In today's video, we're going to be diving into some fundamental developments across multiple different blockchains, discussing and talking about some ongoing happenings on XDC, Axelar, Canton, Chainlink, taking a look at some of the recent announcements that have taken place this week. As of time of recording, the total cryptocurrency market cap has rekindled roughly about $300 billion worth of its losses from the past drawdown that we've experienced over the past consecutive couple of weeks. I want to take your attention to some just ongoing things that have recently developed in the space to show you guys that this space is ever evolving. It is not dead. Crypto is not going away, and we are only just beginning to really see real utility unfold and institutional adoption at scale take place rapidly. So starting off here to prove my point, to show you guys institutional perspectives, this is not coming from me. This is coming directly from Coinbase Institutional and Glassnode, charting crypto Q1 2026 documentation. And if we scroll right down here, it goes on to specifically mention when this survey was taken between December 10th, 2025 and January 12th, 2026. They surveyed 148 global investors, 75 of which were institutions and 73 non-institutions, to get their perspective on the crypto market trends, sector positioning, risk management, and more. And down here at number 2, it goes on to say, despite market weakness, most investors are sticking with or adding to their crypto allocations. Around 2/3 of institutions, or 62%, and non-institutions, 70%, have either held their existing positions or increased net long exposure since October 10th. That is massive confirmation that the vast majority of what just took place in this space was a correction of over leveraged positions, not long-term holders that have a drawn out perspective of the digital asset ecosystem long-term down the horizon, right? So this was just great to see, because this fell in line with something that I said to you guys over here in this post before we get into the fundamentals. And I want to actually physically show you guys this by going over to the charts, where I said here, I truly hope that people understand that the opportunity to buy crypto at a $2 trillion market cap will never exist again once institutions start to flood in at scale. This is the opportunity of a lifetime. Play your cards accordingly, right? Of course, not financial advice. Everybody has their own risk tolerance. I suggest you do your own personal risk analysis and research projects that have the potential and longevity to survive in this space. But to prove what it is that I'm saying to you guys, just in a sense of technical analysis, okay? What we just witnessed in crypto, this is, by the way, the weekly time frame in the total cryptocurrency market cap. What we just witnessed in crypto history over the past consecutive couple of months since October 10th till today is the second biggest drawdown in crypto's history. So I'll take your attention back to the first drawdown in crypto's history, or the first big major drawdown in crypto history in terms of recorded size. The drawdown from 2021 November down to November 2022, when the market started to recover, was a $2.3 trillion drawdown. The recent drawdown that we have just witnessed and lived through, now, if recently we have seen the local bottom, great, so be it. Maybe there might be some more room to the downside if maybe there might still be some room to the downside if risk sentiment worsens comparative to where we're at today. For example, if we did end up going to a war with Iran, or some type of geopolitical escalation or tariff-related debacle unfolded and created a whole risk-off sentiment. I'm not saying that downside risk isn't still prevalent in the current environment, but nonetheless, $2.23 trillion has been liquidated or taken out of the total cryptocurrency market over the past consecutive couple of months. And so my point here being is that this is the last golden opportunity to buy crypto at around $2 trillion market cap before we see institutions scale in. And I'll just give you an example. It is my firm belief that when these institutions do start to flood in, that is when we're going to see a 5 to 7 trillion, possibly even a $10 trillion market cap this next cycle. And I'm talking about when real large scale institutions start to increase portfolio allocation to anywhere between 2 to maybe 3 to 5%. That is going to happen within the next 2 to 3 years, in my personal opinion, right? And so let's just take $7 trillion market cap as an example, okay? And I will highball it So let's say the total cryptocurrency market cap reaches a $7 trillion threshold. If we take the two largest pullbacks in crypto history and average it at around $2.3 trillion, so we were to hit a $7 trillion market cap and then subtract $2 trillion or $2.3 trillion from that market cap, that would still put us at about a $4.5 trillion market cap. So the opportunity now to get into the digital asset ecosystem with this recent pullback, in my personal opinion, should not be something that should have you shaking in your boots, and instead should have you seeing massive opportunities across the board to get in before we really truly do see 5, 6, 7, 10, 15, $20 trillion market cap, which in my personal opinion is absolutely inevitable in the digital asset ecosystem. Most of us who have done our research, including you all following us here at CYPRX, know where this digital asset ecosystem is headed. It's just a matter of when, not if. All right. So position yourselves accordingly, as I mentioned. Now, to show you guys some of the ongoing fundamental developments that have recently taken place, showing you guys that this infrastructure in crypto is the farthest thing from bearish. It was honestly just because of the risk off backdrop in terms of fundamental headlines, hawkish Federal Reserve rhetoric, tensions between Iran, Russia, Ukraine, headlines, and the geopolitical hotspots all over the world, tariff related tensions creating uncertainty that have created massive liquidations and over leveraged positions in a complete restructuring of the current environment. However, the infrastructure has not failed. Blockchain is still doing its thing and serving institutions, real traditional financial institutions, well, and they are adopting this technology at scale at this very moment in time. Directly from the XDC Network news page, February 24th, 2026. USD $1 billion in assets on the XDC network by the end of 2026. This is an announcement directly on Yahoo Finance, and it says Vert Capital, a leader in the Brazilian structured finance space, has recently announced the successful tokenization of two major Brazilian debentures on the XDC network, which is massive, right? This announcement marks a significant milestone not just for the companies involved, but for the entire blockchain ecosystem. This move effectively bridges the gap between different sectors of the economy, starting with Mato, a growth leader in Latin America, urban mobility, and last mile logistics. As a fast moving, data driven representative of Brazil's new economy, Mato has already tokenized approximately USD 60 million with a total target of USD 93 million. Completing this innovation is the involvement of Banco Pine, a powerhouse in corporate structured credit with a deep history of serving mid-market and large corporate clients, with their current tokenized volume reaching approximately USD 268 million. Banco Pine's participation serves as a powerful signal that even the most established traditional financial institutions are now recognizing the tangible value and efficiency of moving complex debt instruments onto a public blockchain. So kudos to XDC for that announcement. Moving on, we saw another breaking announcement today, Chainlink and Canton integration. Now, Chainlink has already been a super validator on Canton, but this announcement came in fresh today, February 25th, 2026. Huge considering the recent landscape that we've seen in the total cryptocurrency market. This just goes to show partnerships and integrations are still happening in order to build out the infrastructure for financial institutions to feel comfortable to fully embed into the space. Canton, the public blockchain purpose built for institutional finance, and Chainlink, the industry standard on Oracle. The industry standard for Oracle platforms, today announced the live deployment of Chainlink's data standard across the Canton ecosystem. With these integrations, the Canton ecosystem gains access to market-leading on-chain data to enhance the security and reliability of Canton applications that drive real-world financial activity on-chain. The Canton ecosystem partners are now already using the Chainlink data standard in production with real-world financial activity on-chain. With apps like Canton ecosystem partners are already using the Chainlink data standard in production with apps like CBTC by BitSafe, Unhedged, and firms such as ThetaNuts Finance, Caro, AngelHack, and Temple, combining Canton's privacy capabilities with Chainlink's industry-leading data to unlock high-quality on-chain collateral, decentralized options, privacy-preserving prediction markets, and more. So that was great to see. While we're on the topic of Canton, I want to take your attention over here to something that an industry leading expert, her name Jenna Pilgrim, the head of portfolio growth at CoinFund being one of the world's largest and most experienced crypto native investment firms, specifically says this.
Distribution will win.
So the topic of today's panel is how can crypto protocols build sustainably when crypto narratives are constantly rotating. So for the first question, maybe let's talk about like what is a narrative and what's driving the narratives. Is it the KOLs? Is it the VCs? Is it just the price? Or is it something else? Go for it, Jenna.
So I think differently from other cycles, we're really seeing revenue and fees drive narrative. And I think that's a lot healthier. It means that those of us who come from traditional finance understand that things can actually be measured. We have some models that we can run on protocols now. And we never used to be able to explain why protocols were able to grow or why developers wanted to build on them. Many people hold the belief that the best technology will win. And I think we've actually seen that to be not true. The best technology won't win. The best distribution will win. And I think that distribution is really incentivized by what revenue and what protocol fees you can pass on to the user. This whole concept of collective ownership, but also collective earning is a new concept. It seems kind of like silly and novel, but yeah, that's a real narrative driving forward, I think.
I'm with you. If I don't
Collective earning, a revenue driving model, right, is going to be that driving narrative moving forward. This is huge considering something that was recently said by Yuval Ruz. Shout out to Coinage for this interview with Yuval that was just posted today, February 25th, 2025. Listen to what Yuval says here because it aligns directly with what Jenna from CoinFund says is going to be the driving force for the next cycle. Take a second and listen.
In the way that things have gone. But one thing around, I guess, the tokenomics, that was one of the things that I know, chatting with Eric a couple weeks ago, learning about kind of the burn mint equilibrium. Maybe I shouldn't have gotten ahead of myself in talking about Canton versus Ethereum, since you're right to point out it is hype in Canton that we have in this matchup. And one of those things that you and I were just chatting about before we jumped on, and something Eric stressed as well, is how much of the tokenomics around Canton are different and still kind of, I guess, able to be adjusted. And one of those things is tying tokenomics back to activity on the chain. And if I remember correctly, also this idea of rewarding builders in the Canton ecosystem rather than just validators, something that you were also kind enough to point out before we jumped on that I may have right as well. So talk to me a little bit about the tokenomics and maybe how that could change as more activity comes on to Canton.
Sure. So to me, I think that what the industry have failed to do well, and this is where I can be very complimentary of hype as part of this discussion, is that I don't think that most chains have done a good job creating a model that actually allow the chain to get value, except from speculation. And even speculation, it's not even the right word, because speculation kind of implies that you're just taking uninformed risk on something that could actually be worth something. You're speculating, oh, I think this is going to be worth something else in the future. And the reality is that a lot of these chains are very different than Bitcoin, right? Bitcoin was created as a store of value. So the value of Bitcoin is determined by, are people willing to assign that value? The problem is that there is no room, in my opinion at least, for 10,000 Bitcoins. There's one Bitcoin, and that's it. And therefore, when you get into like smart contract chains, Ethereum, Solana, Canton, and many more, to me, when you do that, you have to move into a world where the actual financial value that you generate on those networks translates somehow into the value of the token. And I actually think that most L1s have failed to do that. All L1s, really the mechanics of them are speculative, meaning they kind of like try to mimic Bitcoin, even though, at the end of the day, they're all saying like, hey, we're going to become the next set of financial rails. But when you actually look at the activity that is happening on those chains, there's really nothing that is happening. So like you could take an example, and I will take a step here, of Cardano, for example, where there's really nothing happening on the chain, yet the chain is worth $10 billion. And I just don't understand how you can justify that. That to me makes if Cardano says, listen, let's just drop smart contracts and let's just become a store of value and compete with Bitcoin, I would kind of understand, right? You don't need to actually have activity necessarily on it. It's just people hold it like gold, and they just believe that that's a store of value. But when you get into the realm of saying, no, 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 I am going to be the next set of financial rails,
Yeah.
you should be valued by, are you actually becoming that, right? And to me, that was like a critical component of when we designed the tokenomics of Canton, that it actually would mimic something like that. So the reason why I am very complimentary of Hype is because they generate revenue, they actually generate value, and no different than any company that does stock buyback, they buy the tokens back, right? That means that the token should be worth more money. If Hype does more revenue, then Hype will buy more token back, and therefore the value of the token should increase in value. That to me is logical, right? Yep. And if you then take that by extension, that's how Canton works, but it's not at a discretion of the foundation. It's built into the tokenomics itself. If the network does, sorry.
I guess it's also fair to maybe point out too that you guys are taking maybe somewhat of a different approach around the idea of Hyperliquid. I was just out at ETH Denver. Certainly, Canton represented there. Also, Hyperliquid represented there, and the Hyperliquid kind of strategy has always, I think, been built around. At least, maybe you can disagree. Built around kind of the idea of chasing retail traders trying to use Hype, building on the platform. Right now, still a lot of question marks. We just saw them kind of introduce their own, I guess, regulatory regime, their lobbying group, if you want to call it that, down in DC, to maybe fix some of the concerns that probably might exist around, perpetual futures in a platform around that. And for you guys, maybe chasing a little bit more of kind of the institutions of Wall Street. I mean, when it comes to maybe the versions of that, certainly having a bunch of people trading perps on a platform versus having maybe a few financial players using Canton looks maybe a little bit different. Is that fair to say that it's kind of same kind of approach around tokenomics?
I think the go-to-market. Yeah, I think that what you're calling out is correct in terms of the go-to-market, but I try to maybe take a step back and kind of divorce myself from what is a go-to-market, because I can have opinions about perps or even about online gambling. It doesn't matter. At the end of the day, the question is that infrastructure in question generates financial return, and does that financial return translate into the token holders? I think that that's just, first of all, like a critical question to answer. And I actually think that Hype and Canton are really the only layer ones that are actually doing that at the moment.
Okay, so a bit of a lengthy video there, but nonetheless, that just aligns with exactly what the lady from CoinFund went on to say about what will likely be the next incentive model moving forward in the cycle ahead. Leading over here to another huge announcement, Axelar back from the dead, making huge strides in partnerships with other layer ones. We see an announcement just from today, Axelar and Hedera. This is directly from their website. Axelar has integrated Hedera, giving developers and users across on-chain finance seamless access to Hedera's technology, applications, and liquidity through a single programmable interface. The connection enables secure cross-chain transfers and contract calls between Hedera and dozens of blockchains supported by Axelar, providing a common foundation for institutional-grade on-chain products. Now, this comes just days after the middle of February. We also saw an announcement between Axelar and Stellar, where Stellar is now live on Axelar. This integration expands institutional-grade on-chain finance, connecting Stellar's strengths and payments and asset issuance with Axelar's interoperability layer. So that was also huge and something interesting to see. Last but not least, in regards to yield, this is a very interesting perspective. And then we have a massive announcement that just recently took place from the SEC that just goes to show that these institutions are going to want 24/7, always on, always earning money every single second of every single day. That is the environment that we are headed into, and the SEC is giving the green light for that to take place across the board in traditional finance. We'll get to that in just 1 second. This gentleman here, Julian Quam, said, holding Bitcoin is smart. Holding Bitcoin and earning yield on it is smarter. Now, I personally only have a very small amount of Bitcoin compared it to my altcoin portfolio, but nonetheless, take this into consideration on your altcoins that you hold. The same concept that this gentleman here is talking about on Bitcoin. Most corporate treasuries figured out the first part. Holding Bitcoin is smart. But 191 plus public companies now hold Bitcoin on their balance sheets. Strategy alone holds 717,000 Bitcoin, and almost none of them cracked the second part, which is holding Bitcoin and earning yield, or just in general, holding crypto. or just in general holding crypto and earning yield, right? How long have we been talking about earning yield on your digital assets at CYPRX? The opportunity cost is staggering. Pick any 12-month window in the last 3 years, and now imagine that same Bitcoin positioning earning 4 to 12% APY the entire time, compounding and not sitting. The numbers hurt. Now, I went ahead and I used this calculator that they provide down here on their LinkedIn profile, and I did an in-between run of 4 to 12% over the last couple of months since October 10th. And I just did an average of 7% on 2 Bitcoin, because that is how much Bitcoin I personally own. And over the last just couple of months from October until today, February 25th, at time of recording, had I have earned just 7% APY on my Bitcoin, that would have been an additional $3,300 on Bitcoin. And if I would have compounded that every day, probably a little bit more, but nonetheless, $3,300 from October until today that I completely missed out on because I'm just hodling my Bitcoin and personally not earning any yield on it. Now, I'm earning yield on other aspects of my portfolio, but I just thought that that was a great eye opener for those of you all who are not earning yield on your digital assets. Why not? Right? I definitely am looking for platforms that I personally trust, protocols that I am comfortable with to earn yield on my Bitcoin. I personally haven't found any quite yet. I've tested out a couple, but none of them have really super piqued my interest yet. Definitely need to get back into it and look a little bit deeper into the Bitcoin yield and earning platforms out there that exist. But nonetheless, this was just a great eye opener post because yield is the future that we are headed into. And you want to start to get to learn how to work your digital assets. And you want to start to get to learn how and you want to start to learn how to get your digital assets working for you, which leads me over here to this very last post. Anina Sari, founder and researcher at assettokenization.com, posted this 10 hours ago and says, the SEC just granted exemptive relief that the No 1940 Act fund has received before. The SEC just granted exemptive relief that no 1940 Act fund has received before. Wisdom Tree's WTGXX can now trade and settle 24/7 in the secondary market. The settlement asset is a stablecoin, USDC. What does this mean down here? It says continuous dividend accrual now updates continuously using blockchain timestamps rather than at the once daily 4 p.m. cutoff time, aligning income distribution with actual on-chain ownership windows. And so the official announcement, you can come over here to Wisdom Tree just yesterday, February 24th, 2026. This is huge, right? This is just huge confirmation that from a traditional financial standpoint, they are going to be utilizing blockchain rails. They're going to be earning yield 24/7, 365 in an always on market, and they're going to be able to compound that yield every single day, which just backs exactly what I shared with you guys before. Now is the time to start to learn how to earn yield on your digital assets. Now is not the time to be fearful, considering everything that I showed you all in today's video breakdown. The infrastructure is constantly being built out. We're seeing partnerships, collaborations, and major announcements from large industry-leading experts, institutions, and organizations alike. I encourage you guys to really take charge, to get rid of the fearful and doubtful mindset that has swarmed the crypto ecosystem. Tap into a like-minded community like the one that we provide here for you guys at CYPRX so you can stay locked into these types of ongoing happenings. Many blessings to you guys. Hopefully you all enjoyed today's breakdown. With that being said, that's all that I have for you guys today. If you did enjoy, do us that favor, smash that thumbs up button and subscribe to the platform. With that being said, I'll see you guys in the next episode.